This is not a headline. It is a warning. Because in a functioning market, the biggest dealer never says, stop. They hire more people. They run overtime. They take every dollar that walks through the door, but this time, they didn't. Output collapsed by half. While demand didn't just rise, it exploded. 4 times normal levels. That contradiction should not exist. And when contradictions appear at the center of a market, systems don't correct, they fracture. What happens when price no longer controls behavior? When access replaces money? When the largest player quietly admits they cannot keep up? And if this is happening at the top, what do you think is happening everywhere else? Stay with this analysis, because by the end of this video, you will understand why this is not about one dealer or one metal. It is about capacity failure in a world that still thinks everything is liquid. And what comes next is where most people are completely unprepared. Welcome to Boring Currency Ledger. If you've lived through more than one economic cycle, if you've seen promises made and quietly broken, then you already understand why this conversation matters. If this kind of analysis still speaks to you, subscribe to the channel, not because it's new, but because experience teaches you that clarity becomes rare when it matters most. And before we go further, tell us in the comments, from where in the world are you watching today? They did not announce a sale. They did not launch a promotion. They did not ask for patience. They restricted access. That single decision changed the meaning of the market overnight. In any normal system, the largest dealer benefits most when demand rises. Scale is supposed to protect margins, smooth logistics, and absorb shocks. When customers line up with money in hand, a market leader usually accelerates operations. They add shifts, they expand shipping, they capture volume, while competitors struggle to keep up. But this time, the opposite happened. The biggest dealer in the United States cut output by roughly 50% and imposed limits on who could buy. That is not a tactical move. It is not clever inventory management. It is an admission that the system has reached a boundary it cannot cross. For experienced business operators, this is the moment that matters most. Not the price chart, not the headlines, the operational decision. Markets often fail quietly. They do not collapse with noise. They signal distress through behavior that breaks economic logic. A business turning away customers during peak demand is one of those signals. From the outside, it looks irrational. From the inside, it is survival. The dealer did not reduce output because demand fell. Demand surged. Volume ran multiple times higher than normal. Orders did not slow as prices rose. They accelerated. This alone should have triggered expansion. But expansion requires inputs, logistics, and predictability. None of those were available. At that point, profit stopped being the priority. Continuity became the goal. In business history, moments like this are often misunderstood in real time. Observers focus on policy changes rather than causes. They debate pricing and fairness. But experienced decision makers ask a different question. Why can a system built for scale no longer scale? The answer is never visible on the surface. A 50% output reduction at the top of the distribution chain means pressure is coming from upstream. It suggests constrained inputs, unstable delivery, or replacement costs that cannot be forecast. When a business cannot predict its own supply even weeks ahead, rational expansion becomes impossible. This is how capacity failure begins. Capacity failure is not the same as shortage. Shortages are obvious. Capacity failure appears earlier. It shows up as rationing, minimum orders, and canceled futures. It is the system quietly admitting it cannot promise tomorrow what it sold today. For entrepreneurs and business leaders, this distinction matters. Most businesses do not fail because demand disappears. They fail because demand arrives faster than infrastructure can handle. High utilization feels efficient until it becomes fragile. Systems running near maximum output leave no room for error. One disruption is enough to cut throughput in half. That is exactly what the signal reveals. The decision also exposed a deeper shift in buyer behavior. Customers did not stop buying as prices rose. Price elasticity failed. Demand was no longer guided by value calculations, but by fear of access. People were not buying because prices looked attractive. They were buying because they believed access might soon vanish. When the largest player confirms that fear, the entire market tightens. Smaller players lose confidence, sellers withdraw, inventory stops circulating freely. Liquidity does not vanish, but movement slows. Money is still present, demand still exists, but the ability to complete transactions weakens. This is how markets stop functioning smoothly without collapsing outright. For decision makers, this is the moment to stop watching prices and start watching behavior. When a market leader says, "No more," it is not a statement. It is a line being drawn. On one side is the old system. On the other is a new environment where access, timing, and inventory determine outcomes. And once that line is crossed, the system never resets quietly. They expected demand to slow. That is what normally happens when prices rise quickly. Buyers hesitate. Orders shrink. The market cools itself. This rule is taught early in economics and repeated often in business planning. But this time, the rule failed. Demand did not slow, it accelerated. Reports showed buying activity running nearly 4 times higher than normal levels. What made this more unusual was not only the size of the increase, but the timing. Much of the surge occurred during periods when markets are usually quiet. No major announcements, no open trading floors, no institutional triggers, just people buying. For experienced observers, this was the first clear sign that demand had changed its nature. This was no longer price-driven demand. It was protection-driven demand. In a price-driven market, buyers ask one question: is this worth it at this level? In a protection-driven market, they ask a different one: will I still be able to get this later? That shift changes everything. When fear of future access replaces concern over current price, traditional demand controls stop working. Higher prices no longer discourage buying. In some cases, they encourage it. Rising prices are interpreted as confirmation that waiting is dangerous. This is why demand continued rising even as costs climbed. From the outside, this behavior can look irrational. But from the buyer's point of view, it is logical. They are not trying to make a profit. They are trying to avoid regret. They are reacting to uncertainty, not opportunity. This type of demand is far more dangerous to systems than speculative demand. Speculators leave when conditions change. Protective buyers stay until access is secured. They do not trade in and out. They accumulate and hold. That behavior removes liquidity from the system and locks inventory in place. This is exactly what began to happen. As orders surged, fewer sellers appeared. Even at record prices, holders chose not to sell back into the market. That refusal is a critical data point. It shows that confidence in replacement was gone. Sellers did not believe they could easily buy back later. Once that belief disappears, circulation slows dramatically. At this stage, demand does more than strain supply. It exposes structural weaknesses. The market was built on the assumption that rising prices would always bring out more sellers. That assumption failed. Without sellers, dealers were forced to source from tighter channels. Replacement costs became uncertain. Delivery timelines stretched. Demand was no longer something the system could simply absorb. For business leaders, this is a familiar pattern, even outside commodities. It appears in housing, energy, shipping, and food markets. When people fear future scarcity, buying becomes urgent and uncoordinated. Systems designed for steady flow struggle under sudden surges. What made this case more severe was the concentration of demand at the retail level. Retail demand is often dismissed as noise. It is assumed to be small, emotional, and temporary. But when retail demand moves together, it becomes powerful. Unlike institutions, retail buyers are not constrained by models or committees. They act quickly and simultaneously. That is what happened here. 4 times normal demand did not arrive gradually. It arrived suddenly. Websites slowed, fulfillment centers backed up, customer service systems overloaded. These are not signs of success. They are signs of strain. As demand surged, the dealer faced a difficult choice: continue accepting orders and risk failure, or slow the flow and preserve stability. They chose the second option. This decision reveals how demand shocks actually damage markets. They do not destroy demand, they destroy confidence in process. When customers experience delays, cancellations, or restrictions, trust erodes. Buyers rush even faster, sellers withdraw. The cycle feeds itself. Each attempt to slow demand confirms that demand should not slow. This feedback loop is extremely difficult to break. At this point, price is no longer the market's main signal. Behavior is. People were signaling that they no longer trusted availability. Dealers were signaling that they no longer trusted predictability. Both sides were reacting rationally to the same uncertainty. This is how markets enter a new phase without any official declaration. For entrepreneurs and young business leaders, the lesson is clear. Demand spikes are not always good news. They can hide risk. They can mask fragility. Growth that arrives too quickly can overwhelm systems that were optimized for efficiency, not resilience. The most dangerous demand is demand that does not respond to price. When price loses control, something deeper has broken. This is why the demand surge mattered more than the headline number. 4 times demand was not impressive, it was alarming. It told a story of fear, not optimism, of preservation, not speculation. And once demand takes that form, the burden shifts to supply. That is where the real failure begins. If demand rises sharply, output is supposed to rise with it. That is how modern business is designed. Factories scale, shifts are added, logistics expand. When customers are ready to buy, production responds. This relationship is so fundamental that most business plans assume it without question. But here, output moved in the opposite direction. Production did not slow slightly. It collapsed by roughly 50%, and it happened at the exact moment demand reached extreme levels. This was not coincidence, it was exposure. To understand why this matters, it is important to separate 2 very different problems: capacity and inputs. Capacity refers to people, machines, and time. Inputs refer to raw materials. Many businesses confuse the two. They assume that if they have factories and workers, they can always increase output. In reality, factories do not produce products. Inputs do. When inputs disappear, capacity becomes meaningless. The output collapse signaled that the problem was not labor. It was not effort. It was not scheduling. It was something far more serious. The system no longer had reliable access to the materials required to function. This is what makes input shortages so dangerous. They do not show up on balance sheets right away. Machines still exist, staff still arrive, orders still come in, but production stalls quietly, one missing component at a time. In this case, the choke point was not obvious to most observers, so the market focused on retail restrictions and price movement, but the real failure was upstream, where raw material flows slowed. Once that happens, scaling becomes impossible. Even the most sophisticated operations rely on steady input delivery. They plan weeks and months ahead. They assume that suppliers will fulfill orders on schedule. When those assumptions break, output planning collapses. This is why the dealer did not simply push harder. Running a system at full capacity requires predictability. When inputs arrive late, irregularly, or at unknown costs, increasing output becomes reckless. Every unit produced risks being irreplaceable. Inventory becomes strategic, not operational. That mindset change is critical. When a business shifts from how much can we sell to how much can we protect, it signals that replacement risk has overtaken revenue opportunity. That is not a growth environment. It is a defensive one. The 50% output reduction reflects this shift. Rather than exhausting remaining inputs, the dealer slowed production to extend survivability. This is common in industries facing structural shortages. Companies preserve optionality by stretching limited resources over longer periods. To outsiders, it looks like failure. Internally, it is risk management. For entrepreneurs, this moment offers an important lesson about hidden dependencies. Many businesses believe they control their production because they own facilities. In reality, control extends only as far as the weakest supplier. When that supplier falters, ownership offers no protection. This vulnerability is often revealed only during stress. Just-in-time systems, optimized for efficiency, amplify this risk. They reduce inventory buffers to save costs. In stable conditions, this works. Under shock, it fails instantly. There's no slack to absorb disruption. That is exactly what unfolded here. The demand shock collided with a supply chain that had no margin for error. Inputs could not scale, timelines could not be trusted. Output had to be cut, not because demand was weak, but because uncertainty was strong. This is the paradox many markets face today. They appear large and liquid on the surface, but they rely on narrow pipelines beneath. When those pipelines constrict, scale becomes an illusion. The output collapse also exposes another critical factor: replacement cost uncertainty. If a producer cannot predict what it will cost to replace today's inventory tomorrow, selling aggressively becomes dangerous. Each sale carries the risk of loss, not profit. This flips the incentive structure of the business. Selling less becomes rational. This is why output reductions often precede price dislocations. Businesses protect inventory first. Prices adjust later. Observers who focus only on price miss the early warning. The early warning is behavior. Cutting output in a high-demand environment is not an operational mistake. It is a signal that the system is no longer controllable. For business leaders watching closely, this is the moment to reassess assumptions. Growth models based on steady inputs, reliable logistics, and predictable replacement no longer apply. The invisible choke point has revealed itself, and once exposed, it rarely closes quickly. This sets the stage for the next phase of market breakdown, where distribution, not production, becomes the defining challenge. At first, nothing looked broken. Prices were still quoted, orders were still being placed, transactions were still happening. On the surface, the market appeared active, but underneath, the rules that once governed it were no longer working. This is how market breakdowns usually occur, not with panic, but with subtle changes in behavior. The most important change was not the price, it was access. When the largest dealer imposed minimum order sizes and refused future deliveries, it marked a turning point. Markets are built on the promise of exchange. When that promise becomes conditional, the market stops functioning as a market and starts functioning as a gate. Only certain buyers are allowed through. This shift is more serious than most people realize. Price is supposed to be the balancing mechanism. It rises when demand is strong and falls when demand weakens. Access restrictions bypass that mechanism entirely. They signal that price can no longer solve the problem. When access replaces price, predictability disappears. Businesses rely on forward planning. They make decisions based on expected delivery, expected costs, and expected timelines. The moment future availability becomes uncertain, planning turns into guesswork. Contracts lose meaning. Forecasts lose credibility. This is why the refusal to pre-sell inventory matters so much. Pre-selling is not about convenience. It is about confidence. It tells the buyer and seller that tomorrow will look roughly like today. When a business refuses to make that promise, it admits that tomorrow is unknowable. That admission ripples outward. Distributors hesitate, resellers slow down, and buyers rush forward. Each reaction reinforces the next. The system tightens from all sides at once. At this stage, liquidity does not disappear. It changes form. Money is still available, buyers are still willing, but transactions require more conditions, larger commitments, faster decisions, fewer options. This is how markets become less accessible without becoming visibly empty. For many participants, the experience feels like exclusion. Small buyers are pushed aside, minimum thresholds rise, delays grow. What was once open becomes selective. This is not policy-driven, it is capacity-driven. The system cannot process all demand, so it filters it. This filtering reshapes behavior. Buyers no longer ask, is this a good price? They ask, can I get it at all? That question leads to hoarding, holding, and withdrawal from circulation. Items stop moving freely, secondary markets begin to form, private transactions replace public ones, price becomes fragmented. In these environments, the quoted price loses authority. The real price becomes situational. It depends on timing, relationships, and availability. Two buyers may pay very different amounts for the same product on the same day. This is the definition of market fracture. For entrepreneurs, this is a dangerous but instructive phase. Systems optimized for efficiency fail first. Businesses that depend on constant flow struggle. Those with inventory, flexibility, and patience gain leverage. Inventory becomes more than stock. It becomes strategy. This is why experienced operators often shift behavior during such periods. They stop chasing volume, they protect reserves, they wait. They understand that survival depends on optionality, not expansion. The breakdown of access also changes power dynamics. When goods are scarce and unpredictable, the holder gains control. Sellers dictate terms. Buyers accept conditions they would have rejected earlier. This is not exploitation, it is imbalance. Markets eventually rebalance, but not before stress redistributes advantage. What makes this phase especially difficult is that it unfolds quietly. There's no official announcement that the rules have changed. No formal reset. Participants only realize it when their usual assumptions fail, orders are rejected, delivery windows vanish, guarantees disappear. By the time this becomes obvious, adjustment is already costly. This is why strategic warning matters. The events described in this story are not isolated. They follow a recognizable pattern seen in many industries during periods of systemic stress. Energy, shipping, housing, and food markets have all experienced similar transitions. First comes demand shock, then input constraint, then output reduction. Finally, access control. Each stage feeds the next. For young entrepreneurs and business leaders, the lesson is not to predict prices, but to observe structure. When access becomes conditional, when future commitments vanish, and when scale no longer protects leaders, the system has entered a new phase. In that phase, agility matters more than growth, resilience matters more than optimization, and patience matters more than speed. The market has not stopped functioning, it has changed its rules. Those who recognize that early can adapt, those who do not are forced to react. And in fractured markets, reaction is always more expensive than preparation.